Assalamu alaikum wa rahmatullah. Welcome viewers to another episode of Pathways to Prosperity with me, Ameen Hassen. And tonight, alhamdulillah, we're going to be discussing a very interesting topic, at least for me, and that is the world of listed equities. We always hear about the market, about the JSE and how the market is performing and how equities are performing on our daily news broadcasts across the country. You'd see they always show what the JSE top 40 is doing. So today we've got back in studio with us Ridwaan Kajee, who's a senior analyst and portfolio manager at 27/4 Investment Managers. Ridwaan, assalamu alaikum wa rahmatullah.
Alaikum salam. Jazakallah Ameen to yourself and your viewers for having me.
Ridwaan, let's maybe start off with unpacking some basic concepts before we go deep into some of the Shari'ah elements of equities. What is equity? What is a listed equity? What is the Johannesburg Stock Exchange? Maybe we spend a few minutes just as an introduction for the viewers to take them through some of those basics.
Sure. So I mean, I think the starting point is probably to define equity, right? So equity is really the shares and ownership of a company.
Right.
So any company, whether it's a new company or a large listed company, which we'll touch on in a second, would issue shares to its shareholders, which gives those shareholders effective ownership of the business. That ownership allows them, access to profits or exposure to profits and losses in the business through the indirect ownership of the underlying assets and liabilities. Now, as a company sort of moves through its stages of evolution, when you get to sort of large private businesses, a next step in a company's evolution is that of listing, where a company would issue additional shares on a stock exchange. In South Africa, our stock exchange is, or the largest stock exchange is the JSE, the Johannesburg Stock Exchange, where a company can actually list its equities and issue those shares to the public.
Okay.
And that effectively gets them to qualify as being a listed stock or listed share.
So if I were to maybe use different words, in a small business, I own my company and I own 100% of the shares. As my business grows and I need more money, or I want to sell off the value of my business to other people, I look at different places at which I can sell that off. The Johannesburg Stock Exchange is essentially a marketplace where the shares of companies are bought and sold. Would that be a very simplistic way of putting it?
Correct. So I think what's worth mentioning is that before a company does decide to list, there's obviously a lot of criteria that a company's got to look at. There's a lot of introspection in terms of the size of the business, its exposure, how the market will really receive, its decision to list.
And I'm sure there's regulations involved.
Absolutely.
Okay.
So those regulations are things like JSE listing requirements, which they've got which they need to comply with, as well as things like the King Act, which talks about corporate governance, which becomes more of a requirement for companies to follow as opposed to a private company. And what sits in the King Act around corporate governance is the requirement around independent board members, different subcommittees.
Right.
Those type of requirements are a lot more stringent, as you put it, for companies that decide to list, given the level of public accountability that those companies have by virtue of their shares being offered and owned by the general public.
Okay. So we've got a basic understanding of what an equity is and what listed equity is. And we know that investment managers, a big portion of the job that you guys do, which we as normal human beings appoint you as our investment managers. So that would be either through our employment pension fund or provident fund, or through our own personal retirement annuities or unit trust or discretionary savings vehicles that we use. We'd consume a unit trust, or we'd consume a fund, different words or different terminologies that people use. And we basically say to you guys as managers, here's our money, go manage it for us. And a large part of that goes into the acquisition of equities on exchanges across the world. And I think for benefit of our viewers, what we want to get into is the universe of Shari'ah compliant investing. So we've covered in the past during the course of the series different types of Shari'ah investment vehicles. But when it comes to Sharia equities, how do you guys as investment managers determine whether a stock or an equity is Sharia compliant? And let's start unpacking this world of Sharia compliant listed equities.
Sure. So I mean, I think, in the world of investment management, where there's a Sharia compliant equity product that is offered, which means we're selling a product like a unit trust or retirement fund product to the market, where the market can actually trust us with their capital and invest it on their behalf in a Sharia compliant portfolio of equities. One of the core governance functions is the existence of a Sharia advisory committee, which you find across not just asset managers, but across the Islamic financial services industry. And that's effectively made up of scholars that really guide us in terms of the nature or the type of equities that we can invest in. Now, when it comes to Sharia compliant equities, there's a couple of screens that need to be passed in order for a share or business to be considered Sharia compliant. The first one is that of a core business screening, or what I like to call a qualitative business screening.
Okay.
That effectively looks at the core of a business and its primary strategy in terms of how it intends to trade and what types of goods or services it intends to trade in. Now, naturally, the easiest way of understanding this is that if we think about a conventional bank or conventional insurance business or an alcohol business, by its core, it deals in things that are impermissible from a Sharia perspective by virtue of trading in insurance or insurance-based lending or earning being its primary form of revenue. In the case of an alcohol business, naturally, alcohol is impermissible from a Sharia perspective, and those types of businesses would automatically be excluded.
So the first part that we'd look at as investment managers would say, okay, if the stock is haram in its core trading activity, we won't invest in it. It could be the most economically beneficial stock like AB InBev or big banks on the Johannesburg Stock Exchange, like all of the big 5 banks here in South Africa, but because of their trading, their actual core goods and services being haram, you exclude that from the investment universe.
Correct. Absolutely correct.
So that's the first screen. The first screen is what we would call a qualitative screen. What's the other screen that we use?
Okay, so what we then move to is what we call a quantitative screen or financial screening, which says once a business is considered permissible or halal in terms of its core business, so take a mining company, for example, which really is in the business of mining commodities and selling actual physical commodities, we look at a number of financial ratios, right?
Okay.
And there's 3 core financial ratios. The one is interest-bearing debt cannot be more than 30% of total assets.
Right.
The second is interest-bearing assets cannot be more than 30% or 1/3 of total assets. And the final screening is that not more than 5% of its income can be from impermissible sources.
Okay, so the company can be Sharia compliant, meaning a mining company or a telecoms company or a company that trades in goods and services. But in that company may be different levels of impermissible stuff. So for example, they generate cash from their revenue. They take this cash and they put it into an interest-bearing call account, as an example. Or they have an interest-bearing overdraft. So their business itself is Sharia compliant, but some of the activities that they do to fulfill their the financial elements of their business is non-compliant. But now I'm intrigued by this 30% and the 5%. So how did we as an industry come out with this ratio to say, okay, less than 30% interest-bearing debt and less than 30% interest-bearing income?
Sure. So I mean, I think obviously what's important for the audience and the market to really understand, when it comes to Islamic finance in general, it's based on Sharia law.
Yeah.
We know Sharia law is really comes from 4 sources, the 2 primary sources being that of Quran and Sunnah, and the 2 secondary sources being Ijma and Qiyas, which is effectively based on consensus between scholars or analogy.
Right.
Now, it was probably, going into a little bit of the history behind where Sharia compliant stocks had effectively come into or crystallized into a fatwa or an opinion from scholars is that probably happened sort of around the 80s and 90s. There was the dot-com bubble, and I think in those years, the Islamic finance industry globally was still somewhat in its nascency. And I think there was obviously interest to sort of get access to companies that were exposed to the dot-com bubble, had a lot of potential for growth. And there were Muslim investors that were looking to invest, family wealth or excess wealth to obtain returns. And, to cut a long story short, it effectively, the where these percentages had come was actually from analogy. So there's a hadith, and I'm going to quote a very short extract of this hadith, which talks to الثلث والثلث الكثير. And it's actually part of a longer hadith where there was a sahabi that was on his deathbed and said to Nabi sallallahu alayhi wasallam that, I've amassed quite a bit of amount of wealth. I've only got one daughter. Perhaps I should give 2/3 in charity. And to cut to the end of that hadith, Rasulullah sallallahu alayhi wasallam basically said that, and the Arabic ayat I just quoted is interpreted or translated as a third and a third is too much.
Right.
And from that, there was an analogy drawn, and the scholars that had specialized in Islamic finance had basically said that, how do we determine what is excessive?
Right.
So, in terms of what is available in the Western world, there's not a lot of Islamic financial or fully compliant Sharia businesses. Naturally, it's unavoidable to have exposure to these companies, which at their core are permissible, in the example of a mining company or a telecoms company, but there will be some unavoidable exposure to interest-bearing activities.
Yeah, we're in a Muslim minority country, so we can't we can't expect the vast majority of companies to be trading in a Sharia-compliant way. They would do it according to what is permissible by their standards. Exactly,
and that was where the analogy was drawn. That how do we determine, as Muslim scholars or Islamic scholars, what is excessive?
Right.
And there were various viewpoints. One viewpoint is 49% considered excessive, but this hadith was specifically used to determine that a third was mentioned by Nabi sallallahu alaihi wasallam as an amount that is excessive. Hence the ratio of 30% as a benchmark to assess interest-bearing assets, interest-bearing liabilities, and on the 5% of non-permissible income. That's sort of aligned to another hadith that talks to a little is almost like non-existent, meaning that it's unavoidable, but it's a very immaterial part of a business's income in terms of non-permissible income.
Okay, so it wasn't just some randomness that somebody woke up one day and said, okay, no, let's do it at 30%. There's the process of qiyas going into that, and that's how we actually derived this element of 30%. Okay, so for clarity, Maf, so if we were to translate directly, a thuluth would be a third, but now 30% one would argue isn't a third, right? So for clarity, what's the standard? Is it a third or is it 30%?
So there are differences of opinion. Naturally, I think if you look at our fee standards, which are obviously global standards that govern various aspects of Islamic finance, they use 30%. A lot of the Sharia advisory boards within financial institutions take their own view. The majority of views that I've come across is that 30% as opposed to 33.3 as an exact third is used more to err on the side of caution, to make sure that there is some level of buffer you below that third that was mentioned in the hadith.
Ridwaan, thanks for that. So I suppose where the conversation naturally flows, and this is just some thoughts that are sort of percolating in my mind as the conversation is flowing, is you've got these qualitative screens and you've got these quantitative screens. As investment managers, I suppose the largest challenge that you have is you working within a restricted investment universe, but you've got a consumer or a corporate that is still expecting a market-related return. Maybe speak us through some of the challenges that you face and how investment managers would possibly mitigate those risks or work around those challenges.
It's an excellent point. I think if we look at the JSE, I think we've said it before in the previous session that we had, is that the JSE is a shrinking universe of shares that are listed, whether conventional or Sharia. When you strip out, those that are non-Sharia compliant, like we said, banks, conventional insurance businesses, alcohol businesses, businesses that deal in gambling or in non-halal type of products, such as meat that may not be slaughtered in a halal way. It does narrow down your universe, and that's where I think asset managers really have to get very creative in terms of their strategy around which types of stocks they're going to buy, how they risk weight their stocks. Within our business as 27.4, we've got something called multi-factor or smart beta, which says that we understand that the Shari'ah universe of investable stocks is heavily weighted to the resource sector. How do we compensate for that by risk adjusting our exposure to commodities and ensuring that our exposure across different sectors are equal, with still reducing obviously risk. I think before I conclude on this point, I mean, it's probably worth mentioning, just in terms of the screening, a very important part or aspect to clarify for our audience is that these ratios are obviously just, and the scholars' rulings around 30% and 5% doesn't imply that it's okay to deal in interest or it's okay to earn that. Where you're investing in an unlisted share, right? There's more of a moral responsibility, particularly in our own businesses. It doesn't mean we can run our own business, own the shares, and there's an allowance for interest income or not. Because there we have a lot more control. It is avoidable as opposed to investing in the JSE. The other point that I think is important to mention is that there is an implication where an investor is investing in a Sharia compliant share, that the dividends that are paid from that, there is a further screening process that needs to be done in order to purify that dividend. And that is specific to assessing what is the non-permissible interest or income that's been earned by the business, and how does that need to be stripped out of the dividend as an added layer of compliance that I guess the scholars have basically spoken about.
Ridwaan, I think that's a very, very important point. And I know that from a Sharia perspective, we often apply a principle which is called darura, which is necessity. So it's not that we are investing these stocks intentionally to get involved in interest, or that it's okay to consume interest-bearing instruments. But there's a darura, there's a necessity. You may be part of a compulsory pension fund, or you may need to take a retirement annuity because of the tax benefits. And as a result of that, you need to have Sharia compliant equities at the back end of those vehicles. Jazakallah for that. It's a very, very important point. Ridwaan, I think we're going to tail end into the concluding remarks of our episode. Maybe the last point of that we could share with our viewers is, and I know this is a loaded question and a very complicated one, but why does it fluctuate so much? So everybody says equities are the highest risk. Why is it the highest risk rated asset class?
I think a lot of it is a function of sentiment. There's, I guess my background is sort of in private equity and the private side of the investment world. So I have a natural bias to that side of the world, and why private investments offer a better or possibly a more attractive return. Notwithstanding the risk profile, but it actually there's an element of sentiment that is removed from that.
Got you.
What we've seen, and the best example of this is that during the onset of COVID, we saw, within 2 weeks of lockdown, sort of around that March-April period of 2020, stock markets across the globe really tank quite a bit. And that was a function of sentiment, right? And what is sentiment? It's really the market. And when I say the market, I mean investors,
it's the traders, it's the human beings behind the decision.
Exactly, that are taking a decision. And a lot of these traders and human beings are not just trading without being informed. They're taking a view on potential events or actual events that have happened around the world, like COVID, how that may impact a business that may be trading on the JSE in future, and hence is likely to impact its valuation today. So somewhat of a technical response, but that's where effectively there's a view that's taken around the impact of current events on a business's future performance. Does that impact the valuation today? If so, I don't think this business is valued at what I'm holding it at. I need to sell before the price decreases and the rest of the market catches wind of this.
Ridwaan, Jazakallah khair for joining us once again. Viewers, we hope you've enjoyed that, unpacking this world of Sharia compliant listed equities. Until next time, Assalamu alaikum wa rahmatullah.